Look, the way lending works is changing, but most investors don't realise it until they hit a wall and suddenly can't borrow anymore. I've been an investor for over 20 years, built a property portfolio into the tens of millions and spent the last 8 years as a mortgage broker in Sydney's East. And one thing is clear, the market is changing and most people aren't prepared for it. So in this video, I'm going to draw on my experience to break down what's actually changed, why trusts have become a pressure point, why banks aren't moving in lockstep, where borrowing capacity is flowing next, and the simple decision framework that lets you keep moving without doing anything reckless. And just to be clear, I can't give you personal advice on YouTube, but I can explain how the system works and what levers you can actually pull. If you do want personalized advice, please feel free to book a call with myself or my team. With that said, let's get into it. If you rewind 5 years, we were in the middle of COVID. Governments injected money into economies at a scale that we'd never seen. That created the hangover that we're dealing with now. Inflation, rising rates, and a period where inflation eased and asset values appreciated sharply. Property, shares, hard assets, a lot of that moved because people were trying to hedge the risk of money losing value. But here's what makes 2026 different. A second wave of stubborn inflation pressure globally, and regulators are now more focused on keeping the system stable while affordability is under strain. So the big shift isn't just what will rates do, it's how will lenders and regulators behave when investor activity and debt levels start pushing past comfort zones. That's the game in 2026. When one bank stays generous while others tighten, most people think that's an opportunity. It's not, it's a warning. Banks don't announce policy shifts, they just change appetite, and you'll find out at application time. And when majors tighten, borrowing power doesn't disappear, it moves. That's when non-banks step in, because they operate under a different framework and they can keep lending when banks pull back. So the edge isn't chasing the last generous bank, it's understanding where the money flows next. When investor participation rises above historical norms, regulators start caring for a few reasons. And it's not because they hate investors. They're thinking about system-level stability, housing affordability getting worse, investor-driven demand pushing prices faster than incomes, debt exposure rising across the system, and the risk of a market where too much growth is driven by leveraged buyers. And when regulators want to change behaviour, they often do it through lending settings, because that's more targeted than moving rates for the whole economy. So you'll see attention go to affordability metrics like debt to income ratios and debt levels in the system. But this is the part that most people misunderstand. Bad affordability doesn't automatically mean that prices must fall, because prices don't move on affordability charts. They move on the full ecosystem: supply, demand, credit availability, employment, and who is still able to transact. Once you understand what regulators are monitoring, you can stop guessing and start thinking like the system. That's where control comes from. Understanding what APRA tools are designed to do and why their impact is delayed. DTI caps are often misunderstood. Their intent is simple: limit extreme leverage. People taking on debt so far beyond their income. So APRA tries to change the behaviour at the edges by setting hard limits, like capping borrowing capacity around 6 times income. But here's the practical reality. For most borrowers, serviceability runs out before DTI becomes the limiting factor. So the DTI cap can feel a little bit like banning 8-foot tall people from restaurants. You'll almost never meet one, but the rule exists because the system needs guardrails. And the reason policy impacts are often delayed is because banks don't flip a switch overnight. It rolls out unevenly. It filters through assessment teams. Different lenders interpret policy differently. And it takes time for borrowing behaviour to change. Quick one, if you're currently using or considering trusts or complex structures, or you're worried that you might be close to a lending wall, I'll leave the link below to book a chat with my team. No pressure, it's just clarity on where you stand, what lenders will actually accept, and what your realistic pathways are from here. Brokers are paid by the lender, so there's no cost to you for that conversation. Alright, let's get back into it. Now that you understand the guardrails, the leverage comes from spotting where banks are tightening first, because the early tightening points will tell you exactly what the system is worried about. Rather than banning investor lending outright, banks started tightening in the most obvious pressure zones: trust lending. Why? Because in parts of the market it was being used in a way that effectively ignored normal lending rules. For a period of time, some lenders would accept an accountant's letter, sometimes even a self-declaration that a trust was washing its own face, and then they'd exclude the trust debt from servicing when you went back for the next purchase. That's where the whole unlimited borrowing capacity story came from. And in 2026, that's basically dead and buried. Not because trusts are evil, but because the way it was being applied wasn't sustainable at scale. Even if a trust is self-sufficient today, lenders have to think about what happens if rental markets soften, vacancies rise, holding costs lift, or conditions tighten. The lender is protecting themselves and in many cases protecting borrowers from structures that can become fragile when the environment turns. Regulators don't wait for prices to fall before they act. They step in when investor activity and debt levels start stretching the system. That's why they watch things like debt to income ratios and investor share. Not because prices are about to crash, but because they're trying to slow behaviour before it becomes unstable. So poor affordability doesn't mean prices have to fall. It means policy pressure usually comes first. And if you don't understand that sequence, lending changes feel random and they're actually very predictable. Now that you can see why trusts got targeted first, the next clarity piece is crucial. Banks don't all move together, and that's where opportunity and risk both show up. People assume all majors will move at once. They don't. Different banks have different cultures and different decision-making speed. Some are agile and respond quickly to changing conditions. Others are more hierarchical, and policy takes time to flow through teams. That's why you'll see the market behave like this weird patchwork. One lender tightens hard, another holds longer. Another quietly reprices, another changes interpretation, not the written policy. And this is why investors get blindsided. They assume yesterday's rule at one bank is the same rule everywhere. It isn't. Right now, NAB has stayed active in this space longer than other majors. And what does that tell you? It tells you lenders don't just compete on interest rates. They compete on appetite, pricing power, and where they want growth. But you'll never want to build a strategy that depends on one outlier staying generous forever. Because lenders don't send you a warning letter. They just update policy and you find out at application time. Now that you understand bank behaviour, the leverage is knowing where borrowing capacity flows when majors tighten, because money doesn't disappear, it relocates. This is where second tier and non-bank lenders come in. Non-banks don't operate under the same APRA framework in the same way that the majors do, which means they can often lend when the banks won't, or lend more aggressively in certain scenarios. The trade-off is usually straightforward. More capacity, higher interest rate. And here's how you can evaluate that trade-off without fear or greed. If you're paying an extra $5,000 to $10,000 per year, and it keeps you in the game, and it gives you access to an asset that can grow potentially by 50k or 100k in a year over a cycle, then that's worth doing. But that only holds if execution is strong and you're not just winging your way through it. Most people think 2026 is all about interest rates. It's not. Rates are just the headline. The real story is happening underneath, inside a lending policy. That's where decisions are being made quietly. That's where access is getting tightened before anyone notices. And that's where investors usually find out too late, when the bank suddenly says no. So if you're watching rates and ignoring lending rules, you're watching the wrong scoreboard. This year, the real risk isn't a rate move. It's a policy shift you didn't see coming. Once you accept that borrowing capacity can be bought at a price, control shifts to the thing that dominates outcomes in 2026. Asset quality and execution risk. In a mixed market, you can have perfect structure and still lose if you buy a dud, because higher interest rates amplify bad purchases. If the asset underperforms, you feel the holding cost harder. Cash flow gets tighter, buffers get eaten, and the portfolio becomes fragile. So yes, structure matters, but in 2026, the quality of purchase matters even more. And this is where I'm seeing people make a mistake. They outsource understanding to speed. They use a buyer's agent, they want fast execution. They want somebody else to handle it. And look, buyer's agents can be great, but the risk is simple. If they get it wrong, you can't send the property back. You wear it. So speed is not the same as skill. And in this cycle, confusing the two can cost you years. Now that you understand the real risk isn't just structure, it's execution. The leverage becomes building a pathway that still works even when policy tightens again, because it will. So is trust-based leveraged investing? No, it's just narrower. It still tends to make sense when you have strong, stable income, ideally growing income, strong buffers, and you're not relying on one lender ignoring the full picture. What changes in 2026 is scalability. Instead of concentrating with a couple of lenders using lenient rules, it becomes more like a diversified lending pathway, multiple lenders, sometimes a mix of bank and non-bank lenders, and a plan that assumes that rules will change again. And where does investor demand flow when majors restrict? It goes looking for solutions. Other lenders, alternative structures, non-bank pathways. That reshapes the landscape. And it's exactly why policy risk is often bigger than market risk. Most investors obsess over price drops, but the thing that can actually trap you is losing access to credit. If you remember one thing from this video, let it be this. In 2026, lending is no longer a background detail. It's a strategic variable. And the investors who win are the ones who can adapt when rules change, not the ones who cling to a single hack or a single lender. So who's best positioned right now? The investor with strong buffers, strong income, disciplined assets, and a flexible lending pathway. So who's most exposed? The investor relying on one policy, staying generous, buying mediocre assets, and assuming credit will always be available the way it was. And the single most important question you should ask yourself before acting this year is, if lending tightens again, does my plan still work or does it break? And if you want help answering that properly for your situation, structure, lender options, and the cleanest path forward, there's a link below that lets you book a chat with my team. And with that said, thank you for watching. If you got value from this video, please like and subscribe to support the channel, and make sure you don't miss the next one. I'll be posting again next week. I'll see you in the next one.